How compliance was done based on something that somebody wrote on a SOP or something that somebody gave out. This is, you do this, it is done. Your work is done, you can go home. And I'm sure you've seen this also happen, right? When your early days, when you started advising banks on how to do their SOPs. How far do you think we have come from here?
Oh, quite a lot. Because at some point in time, the financial risk was all that was important. Everybody was bothered about it, whether it's credit. Everybody had a system over there, market risk and all. But then I think it was around that 2008 financial crisis, people started understanding non-financial risk or started appreciating that. From there, regulators played a very big role to bring in that discipline into it. But now things have changed a lot. I'm sure we'll get into what is today, but that understanding of non-financial risk as a term is now very much in the industry.
So, from the domain financial risk of, let's say, somebody not paying back a loan, somebody, say, whatever, misusing an account, from there to non-financial, which causes reputational damage, which causes system freezing up. People do understand, but do you think the boards understand how important it is? I'm considering some of the incidents that all of us drop in the compliance. This thing has led to employee layoffs, people not wanting to join, senior level witch hunt, and a bit of huge reputation risk, which continues for quite some time, the pendulum. So is that really understood at the board level?
I think it is getting appreciated at the board level. I cannot say fully understood, but at least there was a time when compliance managers and all were a department. Today it has come to a point they are reporting to the board to be sure that the reputation risk is what has become a area of concern for the boards. You cannot directly quantify the reputational risk, what is it going to impact on your balance sheet, but it's accepted that that has to be looked into.
Yeah, I've also seen many boards, almost like every board meeting, they make a mandatory portion to check reputation risk, right, from the litigation, the issues which people bring up. However, if you look at, certain jurisdictions which are more mature in, I'll say, litigative societies, where things can result in very large awards, people become far more mature, far more aware and far more motivated or moved to see this. Our society is not that litigious. I mean, it's not that clients are, or individual clients are, suing banks or even institutional or even in other financial institutions. So, do you think considering what is our judicial system today, how the corporate law movement, we don't have a class action, etc. But do you think it is without that, can we move to a higher degree of supervision at the board level?
Before we go into the board level, the understanding of the consumer about their rights is what it is getting a lot more clearer now. There was a time when that itself was not very sure. Now the customer is aware of their rights. That can lead to that litigation level if it is not managed well. Take the case of certain countries, some of the advanced countries, the corporate officials are responsible if there are, they have to sign up to the thing. If there is something going wrong, they are liable for that. We are not there yet. We don't have the liability laws here. But the way the industry is going, we may also get there. Then this will get more standardized the way you are saying. Board will also take it more seriously.
True. Yeah, and it goes down from the, habits and culture go top down, correct?